Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. With the cash trade just an hour away, here's what you need to know. Asian stocks and European futures are lower after Chinese retail sales show their slowest rate of growth in a year, while Beijing gives its ailing property sector a boost with new regulations. Richemont gets a new boss, naming the head of Cleef Arpels as its new CEO. Plus, Jamie Dimon tells Bloomberg the chance of a US soft landing is much smaller than broadly expected, saying markets are impacted by, quote, a lot of happy talk. We will hear more from the JP Morgan CEO.
Who doesn't like happy talk on a Friday? Let's check in on these markets then. You did have the Dow crossing 40,000, historic levels, of course, before retracing a little. 5,300 still remains the level for the S&P or thereabouts. But again, a bit of a pause that came through, a bit of a breather. Modest losses on the session yesterday. European futures pointing down by 0.3%. The China story will be an impact there. We also watched the earnings and the impact coming through from Richemont. The FTSE 100 looking to losses of 0.1%, 437 on the US benchmark. Yields grinding a little higher yesterday in the session, 108 on euro dollar. Some of the hawks of the ECB coming out and warning around not rushing to cut rates. Isabel Schnabel saying July should not necessarily be in play, even if June is. Markets Today starts right now.
I think the surprise would be higher rates because inflation didn't go down. That inflation has been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise.
Jamie Dimon, CEO of JP Morgan, speaking to Francine yesterday in Paris, talking about the fact that maybe inflation is going to be stickier, is going to be more problematic and is going to be longer lasting. And in some ways, the market reacted to that yesterday. You saw this reversal, this initial move higher in stocks, taking out records, and then this fade as the session progressed, as maybe people recalculated exactly what is happening and what the data are telling us. There were other factors in the market as well yesterday which kind of speak to that narrative as well. Look at Walmart. You basically got little inflation, so little kind of top line in terms of what the inflationary picture is giving you, but people are trading down. And I think that's really interesting. Higher income people trading down into Walmart, buying bigger, kind of bulkier items.
Yes.
That's a narrative that speaks to maybe an economy that is slowing down. Look at Deere as well. Agricultural prices have come down really sharply. Its numbers may be reflecting that as well. So really mixed signals coming out of the economy yesterday. And I think Jamie's kind of really got an interesting point of view on what is happening here with the data he sees. But it's really hard to read.
Yes, I mean, lots of different Americas on display there, perhaps, in the companies that you cite there. And really interesting, I mean, Jamie Dimon, yes, talking in great detail about the things that might drive inflation or keep inflation at elevated levels. And it's a list of the things that we talk about daily, isn't it? The green transition, military spending, infrastructure spending, trade disputes, fiscal spending, all of these things he cites as things that could put upward pressure on inflation. But he's got previous in terms of thinking about inflation as being more elevated than maybe many in the market do. In his recent annual letter to shareholders, he talked about the business being prepared for interest rates that could be anything from 2 to 8% or even higher, he said at the time.
OK, so they have to put those contingencies in place. And as you say, he has form on this. He's been flagging this. BlackRock as well, out front and early on the views that you're going to have structurally higher inflation.
Do you think he's been wrong?
Well, it's the way you characterize the different elements of inflation, right? You talk about softer commodities in the US, you talk about the trade down. So maybe there's the near term and then the longer term. So the near term, you are seeing that softness in things like commodities. So maybe he's wrong on that front. But if he's talking longer term, those structural changes, the shift to renewables, we're seeing all those tariffs being put in place. You're seeing the dislocations of supply chains. That's only becoming more of an issue, not less of an issue. So structurally, the case to be made that inflation will be higher than precedent, or at least pre-pandemic.
Or the reshoring being incentivised by US
These things
policies.
were not happening 4 years ago, 5 years ago, to this degree.
Beginning of the year, we were talking about lots of rate cuts. We were talking about the Fed being able to cut easily. This was a story that was going to develop throughout the year. Inflation has proved to be stickier. And that has been the narrative that has been building up throughout the year. Now, there's other signals. Anna talks about the kind of many Americas on display here. There are signals that we are seeing signs of a slowdown. The recession talk was was something we were kind of focusing on a few days ago. Now we're back to kind of what is happening with the disinflation narrative. It's those two different factors that the market, I think, is really, and economists are finding really hard to judge right now.
Yes, and I'm interested to take this to the European angle as well. We had Isabel Schnabel then of the ECB warning that she doesn't think we'll get 2 back-to-back rate cuts. So it seems as if the market has come around to the idea, and the ECB has been pretty open about the suggestion of a June cut at least. But so the question then is, well, do we just get one? Is the divergence just limited to, 1 rate cut in the summer from the ECB? Or does it go further than that? Well, she's saying we don't get a July cut, for example. So that doesn't mean there isn't another to follow, but it certainly suggests that her view, and she's been on the more hawkish side, as we know, but her view is that you don't get these multiple back-to-back
So marking
cuts.
that enthusiasm and ensuring maybe the markets, they don't get ahead of themselves. June seems to be baked in, as you say, for the ECB. But the sequencing, and we've been discussing this with our guests, haven't we, in terms of the sequencing of these rate cuts. But the other factor, of course, is the Fed, in terms of how Schnabel is thinking about that. If the Fed is only going once this year, how much of that is a factor in ruling out July as the second cut from the ECB? The markets still see 3 cuts from the ECB this year.
The market seems to be ignoring the tail risk. Simon White was writing about this yesterday. The market is now kind of ignoring the risk of a slowdown and a recession, and it's also ignoring the risk of inflation picking up and becoming more entrenched and stickier. Those two tail risks basically have disappeared.
It's not buying stagflation, is it?
No, it's not.
Yeah.
And it's not buying either of those two scenarios in isolation. Jamie Dimon talks about happy talk. Like, I thought that was only limited to Arsenal fans. But
maybe not by the end of this weekend.
Maybe, we'll see.
Yeah.
We'll see which West Ham shows up. But that's where the market is right now. It just wants to focus on the positives. Equity market, you see it in the bond markets. You see it kind of writ large across many of these asset classes.
And we heard from Mester as well, just to complete the sort of the conversation around rates. We heard from Mester talking about how they just need longer to gain that confidence that they're able to cut rates, and that's what it comes down to. How long is longer? We've been hearing these kind of messages from the Fed for a little while.
And they don't want to put a time on it, of course. They have said they want to see more data coming through, at least 2 more months. Most of them have been saying that. Bostic's saying he still sees potentially one cut this year, and the markets have adjusted just in the last 24 hours from 2 to 1.
So give us the read on China. The data today, basically, the industrial story is picking up.
Yeah.
That presumably is good for the commodities narrative, so we'll talk about that a little bit later on. But the consumer, that's where the struggle is. They're trying to get the housing market moving. The consumer's clearly is still very sluggish. Can the Chinese economy pick up enough speed if the consumer isn't participating?
And that's really key, is the linkages, of course, between the real estate sector and the consumer. The consumer's not going to get going until you address the real estate market. And if some projecting that doesn't happen until the middle of next year, if these policy measures come into place, then maybe you're looking at an underwater consumer in China for that period of time. And how do you adjust around that as an investor? In terms of industrial production and factories, export's pretty good. Industrial production, as you say, coming in above. Those are the levers that policymakers can pull relatively easy at a local level and at a national level. But getting the consumer to spend when most of their assets are invested in house prices that continue to fall is a real challenge. And so you have those economists coming out. You literally need to start giving cash to households in China to boost consumption. They're not quite there yet. They're giving vouchers, subsidies, but there's a need, some would say, for more full throttle support for the consumer. Helicopters at
the ready. So we got confirmation, though, on the China real estate side of things. We've got confirmation of that story we had earlier on this week, that local authorities are going to play more of a role, confirming that they're going to help in digesting the home stockpile.
Yeah.
We hear this word a lot.
Yes, digesting the inventory of home sales could cost up to $1 trillion if it comes through across the country. We're getting a bit more detail on that. They've cut the mortgage rates as well in terms of down payments, so trying to get people to go out there and buy more, but also absorbing that inventory. Now, partly this is a shift of the debt load from the real estate sector to local governments and to government-backed banks. And we were speaking to an academic out of China who's an informal advisor to the PBOC, saying there is a moral hazard question here. And he also said, look, until Chinese buyers of houses don't want to be catching a falling knife. They see prices falling on a monthly basis. They don't want to go out and buy houses that are still, he says, relative to wages, still very expensive, even you see the prices. They don't want to go in and buy these houses yet, still highly priced apartments, as they continue to fall.
When we spoke to the former deputy governor at the PBOC, remember when I was in Berlin recently, and he was suggesting that it is these policies around housing that are the ones that are going to be effective. But there are still people asking questions. When you see such sluggish retail sales, yes, it links to the housing story, of course, but they do ask questions about other stimulus. And I suppose that's a question for next week as well.
Yes. And, of course, the people who are asking for other stimulus may be the same people who 5 years ago were saying China needs to rein in these bubbles and and rein in this stimulus and this spending. So, there's a bit of whipsaw there going on. But, again, the focus on moving away from investment-led growth to consumer-led growth seems to be something that at least Western economists and some of those sitting in China say needs to happen.
The 13Fs were interesting this week, as much as the number of kind of well-known investors are taking fairly decent positions in Chinese tech. They think valuations have finally reached the point where actually they represent good value and you're going to see an uptick. Is this a trade? Is this something that has momentum for longer? I don't know yet, but certainly there's been a number of different notes and filings this week that have suggested that actually some of these big guys are getting in.
It's funny that they've been cheap for a long time. I mean, that's what so many investors have told us. So there's cheap, and then there's the geopolitics, and there's all the other considerations that go alongside it. So it feels as if, is it the valuation that's really changed, or is it?
Well, as you say, the valuation story's been there for like 12 months, hasn't it?
So is this just a trade? That's what I can't figure out yet. Is this something that is going to be more lasting, i.e. this is something that's going to get momentum and therefore is going to keep going for a while, or is this simply just a, you know what, we're going to make 10, 15, 20% pretty easily, but whether or not it has legs beyond that, who knows? And it feels like we're at that stage yet. We don't know yet whether there's momentum behind this.
And the numbers coming out from some of these companies are a bit divergent. So Alibaba, a bit of a miss coming through from Alibaba with that touch point on the consumer, but Tencent performing quite well. So investments as well coming through from, you said, from companies like JD.com and Pinduoduo as well. So to watch how that unfolds, it can be really interesting.
So I'll go from the China story to what's going on in luxury, because that takes us to Asia. And we don't get a breakdown from Richemont of exactly their business in China, but we get a line which is Asia-Pacific, and that is the line that disappoints. So growth of 10% still, but that's below the 14% or so that was expected. Japan really exceeding expectations. America's better than expected. Europe a little sluggish, but not far from the expectation. But it is this Asia-Pacific weakness that stands out for this particular business, even though overall the numbers seem to come in broadly in line with
Japan was amazing, wasn't it?
Yeah.
20% growth. Well above, was it double the estimates? Well above the estimates for Japan.
Yeah, it's a constant FX. And I'm scratching my head to work out what that means for a yen-based consumer.
Volatile, I think, probably. So it's interesting. So Cartier continues to do reasonably well. It's one of the few brands that is raising prices at the moment. So it's interesting to see how that is kind of feeding through into what they can do, because other brands, particularly in the watch space, are struggling to raise prices right now. And you've seen watches come down quite sharply. Johann Rupert still pulls all the strings here. We do have a new boss, though, who is going to be
Nicholas Boss.
He's coming, precisely. He's coming over from Van Cleef, so which kind of. It's going to be interesting to see whether he can what he injects in terms of the business, in terms of the direction of travel. Does he actually change things? Johann Rupert's talked in the past about maybe things slowing down, and there has been some evidence that has happened. Is this a step to maybe kind of re-energise the business? I'd be interesting to know what strategic... Is this a change of strategic direction, I guess, is what I'm really asking.
We will have to send Guy on further reconnaissance missions to Bond Street.
This is where we're leading to, isn't it?
Yeah. I didn't go into Van Cleef. That's a bit above my price point. Cartier looked... there was a very imposing man on the door. So I didn't go in there.
They're not supposed to scare you away.
But yeah, no, I very little research done on that front.
OK. Yeah. We will leave that to others, and we'll have other voices on the programme later on today who can bring us further thoughts on what's going on with the luxury space. Shall we tell you what else is coming up today? We're back to watching the geopolitics. The Russian President Vladimir Putin is visiting China, continues to visit China. He's in Harbin today in the northeast of China. 10 a.m. UK time, Euro area April CPI will be released, and we'll get a further reading on where we are on the European inflation story. Then we get 4 p.m. London time, the Boeing AGM. That, for anyone interested in the aviation sector, really, really fascinating to watch. We're on Sovereign Rating Update Watch. Portugal, South Africa, Spain, Cameroon in the mix. And throughout the day, we'll have central bank policymakers speaking at events. Dear boys. So
I've still got this image. I like where did you end it on Dear Boys. I've got this image of Guy being terrified by this burly chap on the door of the...
There are many of them.
If you're not going to steal anything, then you're fine. They're not after you. It's OK.
Fine.
But we've got Jeremy Hunt speaking later as well. Other things happening. And Pascal Donohoe coming up here.
Eurogroup.
Yes.
What's he going to be talking about?
Well, I guess debt raising is going to be joint debt raising and the Capital Markets Union.
Oh, we're back to the Capital Markets Union. The
you
banking
can't go
union,
a day without.
No, precisely. The Capital Markets Union is going to happen.
Nothing makes a Friday like a Capital Markets Union conversation.
Anna doesn't want to talk about the sport. We can talk about what's happening with the PGA.
Yeah, well, the last block of the programme will be entirely dedicated to me trying to avoid sport conversations and talking about.
It's going to be a Guy Johnson monologue.
It's not.
When he's not running scared from security guards.
Can West Ham show up against Man City? I think is the key question of the weekend.
I mean, yeah. We're torn this week, obviously.
Records are falling.
Tottenham not coming to our rescue. Shock horror.
Yeah. Anyway,
let's see. Big weekend for sport. Guy's going to set us up nicely.
We'll do that. The golf's looking good. Records are falling. There were lots of birdies yesterday. We'll continue with that conversation. You got some boxing this weekend. You got Imola this weekend. Anyway, we'll do that a little bit later on. In the meantime, we'll get more into those Richemont earnings. What will the new CEO plan to do with the business? Oh yes, and there is some sport that we need to talk about. Max Verstappen was talking to Bloomberg yesterday. We'll hear from him a little bit later on. But Jamie Dimon says happy talk is skewing market forecasts. We're going to dive deeper into how traders are actually positioned. How happy are you feeling this Friday? Let us know. IB Plus, BBTV Go is the function on your Bloomberg terminal. The sun is coming up. Looks like a lovely day. This is Bloomberg.
It's a question of business. What we observe is that we have more and more US shareholders. Today, we can only offer them ADR, and we want to offer them shares. That's all, because we have more and more US shareholders, and we have less European shareholders, including French shareholders. Probably because of all the debate about ESG, etc. That's the reality. And then you see quite a difference of valuation between the US markets and the European market. So it's a fiduciary duty for the board of TotalEnergies to study. So I said we'll study, and then when we have studied, we will come back.
That was the TotalEnergies CEO, Patrick Pouyanné, speaking at the Qatar Economic Forum earlier on this week. Let's talk about, and this will become relevant in our conversation, let's talk about US stocks, global stocks, appetite from investors for risk. Cole Smead joins us, CEO and Portfolio Manager at Smead Capital Management, on set here in London. Very nice to have you with us, Cole. Thank you for being here. We'll get to the broader conversation, but just as we started there with that soundbite from Patrick Pouyanné, he's been talking about the possibility of the business listing over in the United States. We spoke to the Euronext boss who said, we'll try not to make that necessary. We'll try and give US investors access instead, better access to buying Total's shares in Paris. What do you make of the US market's ability to value companies over Europe's ability to value companies right now? This is the oil space, but it could apply to other sectors.
Yeah, well, we're the buyer of the oil businesses, so if you'd like to talk to a U.S. investor, you can find out where we are on our website. But I just say that because I think really two things are at play here. One is the regulatory cocktail party conversation. Do you want to go to a cocktail party in Paris and say, I'm a large carbon producer, and everyone, gets sad and walks out the room or leaves your party that night, okay? That's part of this. The second part of it is people are saying, if I move markets, I'll get higher valuations. I don't believe the second part of that. The first part is right, okay?
So the ESG story is true, but the
idea you're going to go to America and you're going to therefore get a higher valuation, I don't agree with that. There were some transitions the last few years from Canada down to the United States. They ended up just being cheap oil and gas stocks in the United States instead of doing that in Canada. So I think that dispersion idea, like, we're going to kind of mean revert the multiples to one, I don't agree with that.
Would you buy Total if it was listed in the States?
I would buy Total if they woke up and said, hey, we want to own a lot more oil and gas assets. We want to consolidate the space. That's what hasn't gone on among the majors. In other words, the aggression, they should be consolidating massively. Go look at the XLE. It's already pretty consolidated. But we're going to get even more consolidated than that. Here's the big idea. Go out and buy high-return assets that you don't pay much on a book multiple basis. Use your stock. That way you're not taking extra risk on a funding basis with higher debt costs.
OK. So in terms of where you are looking for assets right now, where are you looking? You've in the past looked at you continue to look at the energy sector. Yeah. Is that something that continues? And is that solely based in the United States? Are you looking at other assets outside of the United States in those spaces? Are you looking in banking outside of the United States? Where are you looking right now in terms of the mix the US versus Europe versus Asia. We're hearing a lot of people coming on set right now talking about the idea that you want to be looking ex the US. You're a big US investor. You're here in London.
Yeah.
Why are you here in London?
Yeah, that's a good question. So I'll just give you an example in an arena. We like banking in general. I don't care that we're talking European banks or American banks. Our largest holding in our ex-US portfolio is Unicredit. Do I like European banks? Yes, I'm smiling ear to ear.
Yep.
What Orchel has done there is a playbook for what other people should do. So let's just take the Orchel playbook and let's use like a Barclays, for example. We don't own them, but just as an example, they're out saying, hey, we're going to buy back a lot of stock. They're trading like 55 cents a book. The question is, can they get back to 10% return on equity? And I'm not talking tangible, I'm just straight up return on equity. If they can, and you can do that over a long period of time, you get book value. So if you can buy back a lot of shares below book, you're eventually going to get book value. That's a nice way to make money. I say that because there's a myth out there that there's this American style of capitalism that only Americans can do. It's crazy when I hear that. It's like, oh, yeah, buybacks were created for Americans. By God, no. This is capitalism. It's just that the Americans have been a lot more aggressive in that style of capitalism. But again, using Orchel as an example, he's been doing those same things. Did the Americans say, oh, this person over here is doing it, I should go own that and make a lot of money? No, they were losing money in banks that disappeared a year ago. So I say that because it's interesting. The opportunities are moving. Some of the same phenomena are going on in the United States and out, just like oil and gas, banking. Those are big places for us. So it's not uniform, but you were just talking about luxury. Luxury is starting to begin to struggle. Okay, there's the Kering woes. I would say Kering shot themselves in the foot in some cases. At the same time, they're a lot more confident.
You're talking the Gucci part of that business?
Correct, yeah. People are more confident in Louis Vuitton. Well, Canada Goose reported yesterday. Canada Goose's business is doing well in China. So I think freshness is a question of luxury. How fresh is your product? If it's a product people have had, quite a bit of the last 10 years, we're going to see a tiring of the consumer in those places.
Is it also a need in this environment, a greater need for that kind of bottom-up approach? Rather than buying a sector or buying an index, you have to have that bottom-up approach. I know this place, you're smiling because this is what you do, right? But
I didn't pay him to say this.
Is this now...
Active management works.
Is this now... active management works, question mark.
But
history would challenge that view. But this particular moment in time...
Yeah, so it's a lovely question. I just got done telling investors here on Wednesday that the S&P is going to make zero over the next decade, and if I'm wrong, I think I might be high, including dividends reinvested, by the way. So here's why I say that. That is the setup for... the S&P 500, which is a broad gauge of U.S. stock risk, but it's really a broad gauge of mega cap stock risk, is what I would argue. That's the problem for the United States. That doesn't mean every stock's going to do poorly. That just means how most people participate in common stocks in the U.S. Are going to do poorly. People here in London over-own the S&P 500, just like people in the United States don't own any non-U.S. stocks, to our discussion just a second ago. There are some more unique things here. For example, we've been buying Tungala, South African coal business. Here's the funny thing. I go to this conference and I say, here's the deal. Shame on all you buy-side PMs in the room who work for these big investment managers who are great marketers, maybe not such good investors, that won't own that for their customers, but they own it in their PAs. That's a conflict. They think it's incredibly attractive for themselves, and yet they won't buy it for their customers. I think that's ridiculous. I don't think that's good capitalism, but yet what's going on here...
This is regulation?
Regulation around ESG or what the customer wants.
But someone's got to meet those climate goals, Cole.
They got to meet their climate goals, but we also have to have humans flourish and have this economy and this world grow.
Coal buying coal. There we go.
Those are two different worlds.
Rare coal.
Yeah. Well, so, I mean, if I can buy a company where I can net out the cash and buy it for 1 times free cash, people are like, how long do you have to own that business? I said, well, a year. A year, maybe 2, and if I get 20, I can get really wealthy. By the way, go look at the history of Anglo and other companies selling coal assets. They sell it to a private buyer. Boom, 10 years later, you open up the billionaires list. Who's there? The buyer.
Right.
And I want to be that buyer.
It is a really interesting conversation about whether regulation just pushes things off into private markets rather than keeping them in public. Cole, this has been excellent. Please stay with us. Cole Smead, CEO and Portfolio Manager at Smead Capital Management. We're going to find more time for Cole in the next part of the programme. We will also find time to talk about China. China's lopsided recovery. Factory growth moves up a gear, but consumption unexpectedly slows. We'll take you through the numbers next. We're hearing also from Tom at the top of the programme about what they're doing around the mortgage side of things and trying to lower mortgage rates, essentially, to try and get rid of some of that stock in the housing market. This is Bloomberg.
I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But engagement is the right thing to do.
OK, JP Morgan CEO Jamie Dimon, of course, speaking to Bloomberg's Francine Lacqua at the Global Market Summit in Paris with a view there on China. Staying with the region, China's consumer spending growth unexpectedly slowed in April, but industrial production accelerated, the data highlighting then the lopsided recovery of the world's second largest economy. Let's bring in Lucille Liu from Beijing now for the details. Lucille, what for you were the key takeaways from this data?
Yeah, that's right, Tom. I think, what you call it, the two-speed recovery, the unbalanced, lopsided recovery, I think that's sort of the key to April data. So we did see great industrial output. That's mostly on exports. Consumer spending, of course, still very weak because of that sentiment being quite low still. Actually, that level for consumer spending was the lowest since 2022. So it's quite a mark. And although, of course, we have been seeing some measures, for example, the property ones that were just released around noon today. So, obviously the government is reacting and trying to really support basically the biggest drag on the economy there. But, in whole, it does bring up this question of sustainability because we've seen those tariffs from the U.S. and, of course, the ongoing EU investigation. The driver of that strong growth might not be so stable.
OK, so let's dig into that a little bit. You referenced what they've done in terms of the property sector today in terms of reducing some of the minimums around the mortgages. They're trying to get the housing market moving. We've seen a series of announcements over the last few days. What are people telling you about kind of where the point is reached where actually we start to see some of these policies gaining traction? Tom was raising the point a little bit earlier on that many people are simply saying you're going to have to give people money. If you want to get the consumer moving, you're going to have to hand out checks in the way that we saw the US doing during the pandemic.
Yeah, that's right. And that's the one thing that I think the government has signaled its reluctance to do. So, I mean, on the housing policies, it is kind of the biggest ones we've seen sort of, this year at least. We've seen that small trickle of incremental things and, that's not helped things at all. In fact, month on month, April data, housing prices were the lowest in a decade. So, this couldn't come at, it's really quite needed. But those three things that they're doing, lowering the rates for, the payment ratios for first-time buyers, scrapping the floor for mortgage interest rates, and, of course, encouraging local government to acquire homes and convert them into affordable housing have been rumored in the market. We reported some of that. It has had some impact. We've seen stocks move a bit. But these are pretty big moves. But, of course, analysts are saying, it all depends on the implementation. How are you going to encourage those local officials to buy back that land and provide affordable housing? So, the details on that we might get. There is a presser this afternoon. So certainly stay tuned.
We will. Lucille, thank you very much indeed. Lucille Liu joining us on what the latest looks like out of China. Cole Smead is still with us. 13Fs. There's a theme running through 13Fs, one of which is that a number of big US investors have started buying Chinese tech stocks. Is that something you'd be interested in? A valuation starting to look cheap enough in China that you think international investors should be dipping their toes in here? Is this an opportunity you can't afford to miss? Or should you be wary? Is it something that's kind of just a trade, or is this an investment?
Yeah, I don't think there's ever an opportunity you can't afford to miss. I think that's like it's like a millennial YOLO
There are
kind
many
of thing.
different types of opportunities.
No, I agree. So use Alibaba as an example. They produce about 15% return on equity. Okay, now part of that is going to social agendas of the government as well. So I think you have to be thoughtful about those kind of things when you look at Chinese companies. And then you have to ask yourself the question, let's say there's a 3 to 5% chance I have a zero because of some political problem and I'm the outsider to that situation. That's the kind of math we run through as we look at businesses like that. Do I think 15% return on equity is that high? No. You'd want to find a much higher return on equity business. But I just say that because the positive about China is all the coolness of it from the 2010, China's the greatest thing since sliced bread conversation. That's gone. Now, China's talking about how do we get our economy going, and they're going to look and say, well, how did the United States do it? Well, the answer is just spend money like it's, like you have unlimited amounts. That's the idea that they're toying with. And I say that because we're spending 7% of our GDP right now as though we're going into a depression.
It's amazing, isn't it?
And we have the tightest labor market in history.
Yeah.
And don't worry, though. This won't be inflationary. The Fed's got this completely under control.
Right.
So, and Dimon yesterday touched on this idea of like 2 to 8% is what they're preparing for. And 8%? I mean,
this is a U.S. 10-year, right?
10 years, what he's thinking about from and he said possibly higher.
I think he was saying that the business is prepared if rates were in that range. The business could cope, but then he then also said, and more,
and more,
more. As if, he's not forgotten about the possibility of higher rates. But you think we are going to see then a higher rates for longer environment. We never go back to post-GFC with that low rates environment. How used to inflation, Cole, do we need to get?
We need to welcome it. We need to treat it as our friend and try to take advantage of inflation versus saying, I don't think it's possible. I mean, go back. Someone said something interesting to me, and I hadn't thought about this. They said PMs have got, here in London, have got, they're pretty good at saying, I'm sorry. And I said, you're talking about low rates. In other words, many people said, whoever will know, or we will never do that. And they came and said, obviously on higher rates, I'm sorry, we got that wrong, both equity and bond type people. Well, the reality is people now look and say, to your point, 6% 10-year Treasury? Not a chance. And Dimon is putting it in his plausible outcomes for the bank or higher, okay? And so I think that's the scariest thing. You're a VC person, you're a PE person, you're a stock person, you're a bond person, you're an asset owner in general. When the risk-free rate goes to that level, you have a serious enemy of your capital base. And the question is, who will deal with that the best? It will be poor for everyone, but in capitalism, the interesting part is the secret to life is weak competition. If someone else loses 80% of their value and you lose 20, you're wealthier in society. And I think we're going to see some of these games where who loses the least or who doesn't lose money might be the actual winner looking out over the next decade in certain asset classes.
Okay.
We're, of course, working through inflation here in the UK. You like oil, you like banks. Are you buying UK assets?
So we own some UK assets. We own NatWest as well here. We own IWG. I'm a big fan of Mark Dixon. That's been bumping up to new recent highs. What I like here is optimism's low. Okay. What I don't like here is there's a historical stigma around buybacks. I don't get it. It's like they treat it like the gnomes of Zurich. If they raise their dividend, the gnomes of Zurich are going to come out of their woodwork and they're going to pour money to their hedge funds and buy the extra income that these stocks provide. And yet you look at all the income of the last decade, and it didn't reward anybody.
Fans of dividends, though, in London.
Pardon me?
Fans of dividends instead.
There's big fans of dividends, but I think what we're going to see is that the dividends do get taxed. So I get taxed like you guys get taxed on income, versus I get a buyback and I get all the money. Yep. In the form of taking other shareholders out. So I think that after-tax conversation needs to become a bigger one. But I just say it because, again, it hasn't been historically popular to buy back stock here. That is changing just like it did in continental Europe. And I think we're going to continue to see that flow through. People need to be dynamic here and say, what is best for capital is how we should treat investors. Who cares what the old standards are? The last decade of poor stock returns here, is that a good standard to go by? And people always say, well, that's what everybody's done. Is that a good measure, though?
OK, Cole Smead, thank you very much indeed. Always colourful. We can't get a shot of your cowboy boots, I don't think. We did have one at the start. Cole Smead, CEO and Portfolio Manager at Smead Capital Management, always entertaining and insightful on these markets. Coming up, we're going to take a look at your stocks to watch, including Richemont. Change at the top of the Swiss luxury house. The details are next. This is Bloomberg.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I could point a lot of times in history where that was true, and the next year it wasn't true, and so. We'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest
rates? I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation's a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year. And we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high. And I think the chance of inflation staying higher or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
JP Morgan CEO Jamie Dimon speaking to Bloomberg's Francine Lacroix at the bank's Global Markets Conference in Paris. Joining us with his view on the markets, our Markets Live executive editor, Mark Cudmore. Mark, is there too much happy talk propping up markets these days?
I don't think there's too much happy talk. There is happy talk. Look, markets are ebullient, markets are effusive, but the fact is we have generally still good global growth. Yes, there are a few cracks showing, but overall still pretty strong. Companies are making very good profits. Financial conditions are still extremely loose, and we've got central banks that are saying, hey, we're dying to make it even easier as soon as there's a hint of a problem. So markets are extremely happy for good reasons, and therefore I don't think there's too much happy talk. There's a lot of happy talk, and at some point it'll seem misplaced, but not yet.
OK, there's a lot of happy talk for Chinese property right now. I just see that Chinese property stocks extending their gains to more than 8% higher on some of the policy changes we've seen coming out of China. Mark, we've seen lots of 13F filings that have flagged increased exposure to Chinese tech. Here's the property sector getting excited about regulatory change. Is the market finally catching up with your view on Chinese stocks?
Yeah. I mean, you phrased that very positively there, Anna, as if I've nailed this. No, I was way too early. So I think those people who are late to this story have proved smarter. It's always the way. You don't want to be early on a trade. You want to be just after it turns. And look, but I think that the fact is that the Chinese stock story has turned around. And we've seen that for a few months now, and that's been quite clear. And while I was too early, I would say several others on my team were quite smart about being bearish until maybe a few months ago and then got bullish. These are stocks that are still extremely cheap. They're under-owned around the world, and now they're getting multi-pronged policy support. Monetary policy, fiscal policy, and there's getting structural reform. So this is a theme that can run and run and run for many, many months to come. Now, an important disclaimer is that over the last few months, the gains have been extraordinary. I was just this morning looking, whenever you see HSI returns of this strong for so long, you get some kind of short-term pullback, but it'll be a short-term pullback in a sustainable uptrend.
Markets Live executive editor, Mark Cudmore, sticking around, I think, in terms of kind of... Mark, are you suggesting that you're taking a different tack to Jamie Dimon? I just want to be clear on this. Jamie thinks there's a lot of happy talk out there, and he's kind of a little concerned about what is happening. He thinks markets are high. He thinks there's a possibility that you would take a different view to Jamie Dimon, yeah? Neither of you wear ties, and that's maybe the only commonality.
I'm very happy taking a different view to Jamie Dimon in the context that, look, I'm not a person running one of the world's most important banks, and kind of key to the financial system. Jamie Dimon does his role exceptionally well. But his job is not making market strategy calls. And Jamie Dimon's timing around recessions, around yields, around many other things have repeatedly not been a very good guide. And this is not to undermine him. It's not his core job. He provides a very important input. He's also thinking in very different time frames. So, when he'll say things are getting a little bit more nervous, if we get a recession 18 months from now, he'll say, look, I was warning it was coming. Unfortunately, 18 months away is too long a horizon for many of the people who have to make decisions. I'm not just talking about short-term traders or day traders. I'm talking about pension allocators or real money allocators that have to make decisions on a weekly, monthly basis, that have mark-to-market issues, that have investors they have to explain to. And for those kind of people, Jamie Dimon's calls are not very useful for markets. They are insightful in terms of the CEO of the world's most powerful bank, the most important bank. Getting his inputs, his perspective is one part of the picture, but I wouldn't listen to him in terms of market timing.
I thought you were going to end there. I wouldn't listen to him. Full stop. We're all just debating whether we need to set up a match-up between you and Jamie. Mark, thank you very much indeed. Markets Live Executive Editor Mark Cudmore on those Jamie Dimon comments. We appreciate it. Remember, of course, you can get up-to-date analysis from Mark and the rest of the team. Just go to MLIV Go on your terminal. Now, to a banking story that our team has been working on. Bloomberg understands that Ping An is weighing options to reduce its 8% stake in HSBC. The Chinese insurance giant is the bank's biggest shareholder and has been the bank's biggest bear bug or bugbear. Is that the way?
Bugbear.
Tom, yeah, they've been an annoyance, haven't they, Tom? Tom Metcalf from our finance team joins us with the verbiage on this. What's the next likely step then from Ping An? Is this good news for HSBC?
Yeah, it's really interesting. So, kind of, as you say, they have this 8% stake, and they've got a few options. You know, they're definitely keen to reduce their stake. We understand what that means. It could be a whole variety of things, right? It could be, you know, fairly incremental drop down, or maybe gets, you know, quite sizable. You know, I think in terms of next steps, probably the most likely thing is they'll be concentrating on trying to sell it into the market. Just as various sort of practical challenges to trying to find one big investor. But I would say if you know, if they could click their fingers and make one thing happen, it would be some, you know, very wealthy investor comes in and not necessarily the whole stake, but takes off a chunk of it, because I think from their perspective, they want to take a little bit of profit from the recent HSBC share price rise. And also, you know, as you say, they've been a bit of a bugbear with HSBC, and I think this is a clear sign they feel, at least their campaign, they've got as much as they could from that, and now they're sort of probably not going to see much more structural changes.
So should investors treat this stake, and it's a sizable one, as we've already indicated, as an overhang?
Well, certainly City analysts are thinking that. I mean, I think that Ping An, I don't think, are in any way a forced seller or anything like that. So I think they're
going to sell at some point, so you should maybe treat it like that. And it really depends on who they sell it to. One big kind of offload would be great, but if they drop it into the market or have to sell it, kind of sell in sizable chunks, that's an overhang.
Yeah, you'd think that would put some downward pressure on the shares. But yeah, obviously, you know, the alternative, like the dream scenario probably for all sides, is some very wealthy investor comes in who's perhaps a bit less, kind of more on board, shall we say, with HSBC's strategy, and that removes, you know, some problems on the HSBC side, and also, you know, probably everyone leaves happy in that situation.
OK, Tom, thanks very much. Thank you for the update. Bloomberg's Tom Metcalf with the latest on HSBC and the banking sector. Let's turn to other stocks that could be in focus this morning. Joe Easton from our equities team has a rundown. Joe.
Morning, Anna. So we've got some really strong numbers out of Richemont today in the luxury sector, driven by the Asia growth at the Swiss firm. These are some of the brands that they are known for. In jewellery, they've got Cartier, Van Cleef and Arpels. In watches, Panerai and Jaeger-LeCoultre. I'm trying to see how many of them I can mispronounce in one go. Yoox Net-a-Porter as well, the retail business. But the most important news today is they've got a new CEO, the leader of Van Cleef and Arpels. He is moving over, Nicholas Boss. He is going to be the new CEO of the group. The current CEO becomes the COO. Now, the company says in a statement that this is part of their shift to a more retail and jewellery-driven approach. So they've taken one of the jewellery leaders and moved them over to the group CEO. We can see the stock pretty much performed in line with LVMH, one of the other big firms, but underperforming the real gainer, Hermes, the Birkin bag maker. That's been the big winner. But the analyst rating screen, very exciting. Not a single sell, 20 buy ratings. Clearly, everyone very positive. We'll see how they take that shift to the more jewellery-focused region in the open this morning. Then we're also going to look at a couple of brands I'm more familiar with, H&M and Zara. RBC analysts are switching their preference today. They are upgrading H&M and downgrading Inditex, the owner of the Zara retail chain. They say this is partly due to the cost of living crisis, which is still driving favourable sales towards H&M and away from Zara, which is priced a bit higher in the pricing on the high street. The other big factor is that H&M is more exposed to raw materials that they think will continue to decline, particularly in cotton, which they say is one of their bigger areas of costs. And Inditex does trade at a pretty big premium to the retail sector and just a small discount to luxury. They think that is now overvalued. We'll bring up that stock on the screen here. We can see that Inditex share price actually outperforming, a pretty good gain over the past 5 years, up 83%, hence why RBC is turning more bearish on that one. We're going to bring up the analyst ratings on H&M, though. Look at that, 10 sells on this one. So not everyone positive on H&M, not everyone seeing those cost of living benefits for that one. Then we're going to look at Haleon. This is in the pharmaceutical space. This is the business spun out of GSK, the consumer health business. Some of their brands are including Advil and also Panadol as well. GSK is selling its entire £1.2 billion stake. This is representing 4% of their holding. When they spun the business off, they had 13% of the business, so they're now exiting that entirely. There's a couple of the brands down there. Sensodyne toothpaste as well. It is priced at a discount, so we would expect to see it come down, but you can see it trading up about 8% since the spin-off previously. And worth noting, more money raised on the London Stock Exchange this year than any other exchange in Europe. It's not in IPOs, though. It's all in secondary offerings like this. Keep an eye on Haleon on the London Exchange today.
OK, Joe, thanks very much. Our equities reporter, Joe Easton, joining us with a look at the stocks that could be on the move. In terms of the European futures picture, we are expecting a little bit of downside, a little bit of upside in the US, either side of the flat line, though. A day after we saw the Dow go to new records. Nobody cares, says John Alsers, because of the way it's calculated.
Nobody should care about the Dow.
And nobody should care about round numbers.
No.
Also his
round
view.
numbers, I think, are more interesting, but the Dow, it's an average.
He takes issue with all of it.
There's a way that it's calculated issue, which I think has long been recognised. It's an average. Higher the share price, it doesn't make sense.
It's not based on market caps, is it? It's just based on the share price. Right, we won't mention that again. I won't say it. We will talk about what's happening at the start of European trade, though. That's coming up next. The European market open for Friday is next. This is Bloomberg.
Friday the 17th, couple of minutes to go until the start of equity trading here in Europe. We are called fairly flat. Stock 600's up by around 0.5% so far this week. The real gains have actually come out of Denmark. Denmark's had a good week. Switzerland, the stock market there's had a fairly good week as well. The pound's had a good week this week as well. It's up by around 1% versus the US dollar. It's interesting, we are seeing a little bit of reaction in bunds this morning as well, maybe in reaction to those Schnabel comments, but not a big one. And weirdly, actually, you've got, to a little bit of movement, but not much. She's talking maybe about the fact that you do get a cut in June and then you don't get another one in July. But the stock story this morning, I think it's been a fairly positive week. We're kind of running out of momentum a little bit on the earnings story. The earnings story out of the States yesterday was fairly mixed. But as you come into this weekend, what do you do with these markets? You've had a decent run. Do you start to take profits? That's, I think, a lot of what managers are going to be thinking about. Yeah, we're going to be looking ahead to key earnings next week with Nvidia, so that'll give us another leg to the AI story, if there is one. So we'll see how that one plays out. I've been really quite taken by the number of comments we've had about fiscal spending, and political economy has reared its head on this programme in the last few days, which is, really speaks to the way that developed market economies have changed and shifted, and the geopolitics is not what it was, and therefore economic policies of these governments is not what it was. And talking of political economies, there's one that stands out today as well, which is China, and the support that's come through. Pretty significant support, whether it gains traction, whether it really lifts. We saw the property stocks lift on the back. Iron ore is higher on the back of those measures, so we're watching the mining stocks in the UK as well. We are 10 seconds away from the open this Friday, with European futures pointing to a sluggish start as we look for those catalysts. Maybe it is Nvidia next week, currently pointing low by 0.3. Let's see how things open. With the earnings story still in focus, Richemont as well, and we watch as well HSBC. That's going to be interesting on the Ping An news. What's standing out to you, Guy, at this point? Not a lot. So let's just switch things up, talk a little bit about points. Cole Smead's having a good morning. Unicredit looks like it's a little bit higher, first thing. He was mentioning that as one of his key shareholdings. Unilever, AstraZeneca, Unilever, BP, Rio Tinto, BNP Paribas, where the gains are coming through. You would have thought that actually that would be reasonably positive for the London market. You've got this Haleon story as well coming out of GSK, which is something we need to bear in mind. Tech looks like it's a little bit soft. ASML is certainly trading a little bit lower. Novo, I talked about the Danish market having a good week weak this week. Nova's a little soft as well, so that's going to add some points onto the downside. But I'm trying to see if there's a read across into luxury. So LVMH is a little softer this morning. HSBC is also a little softer as well on that Ping An story.
Just looking at the sector breakdown there, not that many sectors in positive territory. So is this sort of downdraft to the picture this morning? We do have BT Group a little higher this morning, but so telecoms is higher.
Squeezed higher yesterday, much to the...
What was it, 17% pop?
It made the CEO very happy.
She was front page of the FT.
Yeah.
She likes squeezing the shorts.
And very new in the job and a friend of the programme, so we look forward to speaking to her when she has time for that. Technology, the worst performing sector on the Stock 600 this morning. We are down on tech stocks, ASML and the like.
Maybe that's a yield story. Yields were up a little bit in the session yesterday. The higher for longer narrative from those FOMC officials. H&M performing very well today. One of the lead gainers adding, 2.5%. This was flagged, of course, by Joe Easton on some of the details around that story. So we keep an eye on that. HSBC, as you mentioned, Guy, currently just down 0.2%. So Ping An with that 8% stake. Not a huge move, and it's how they unwind that holding, of course, that's going to be watched closely. Haleon currently down 1.3%.
There's a little bit of a... So the US market continued to fade as after the European markets are closed yesterday. So there's a little bit of catch-up maybe coming through into these markets as well this morning from that position. So I think you just got to bear that in mind too. You've got yields ticking a little bit higher too, so that's a factor maybe we need to bear in mind. Maybe the Schnabel comments are having maybe more of an impact there as well. Richemont is open, I understand.
Yes, and it's on that graphic you can see on the screen. It's the top of the Stock's 50 top performers, so it's moving higher, up by just over 4% this morning. So beating estimates, certainly in some regions and overall. And then a new CEO, also a highlight from the earnings report that we got.
So is this a sense that this is a strategy change? Because the fact that the former CEO is going to become the chief operating officer, i.e. managing the business on a day-to-day basis rather than setting strategy, would seem to imply that Boss has been brought in to maybe kind of finesse the strategy in terms of what they're doing with the business. The sense seems to be this morning that maybe he will focus more on the hard jewellery side and push that side of the business a little bit more. So maybe this is a sense that there is a need for a strategy rethink here, and you are going to see maybe some upside on the back of that.
Well, investors are really enjoying it right now, up 5.5%, whether that's the executive changes and the strategy expectations or the fact that they met those estimates and performed particularly well in jurisdictions like Japan. The US was also pretty good as well. China a bit more of a drag. But let's get more analysis on the Richemont story, given the stock is up now 5.3%. And bring in Bloomberg's consumer goods reporter, Dasha Afanasieva, who's been across this story for us all morning. Dasha, a shake-up at the top. That's what stood out to you the last time I spoke to you. Give us your take right now on what that could mean in terms of the executive change, the CEO, for the strategy for this business going forward.
Morning again. So as they explained, this change is about really focusing in on the biggest jewellery division that's growing a lot faster than luxury watches. That's because the new chief executive is Nicolas Boss. He was the chief executive of Van Cleef Arpels, which is the jewellery brand that has those famous bracelets with little crosses that everyone has copies of. And but what's interesting and why I don't think it would be a complete departure, it's more like a sort of doubling down on strategy, is that the current CEO, Jérôme Lambert, is actually sticking around. He's going to be chief operating officer, reporting to Nicolas Boss. So I think it's the message that, you know what, we're going to focus on jewellery, and that's our unique value proposition, because if you think about the other luxury goods companies, they're not as exposed to luxury jewellery. Obviously, LVMH has Tiffany, and that was a long-running saga, but it's not the specialism of luxury jewellery.
OK, so we'll see where the CEO change takes us then, Dasha. What about the China story? I was looking at the regional breakdown that they give us in the sales report here, and you get a number for Asia-Pacific. I'm not sure if we get a breakdown specifically for China, but it is China that has been a source of concern for many investors when you look broadly at the luxury space.
Absolutely, and I think that's been the concern here. They've missed in Asia-Pacific by quite a margin, and it sort of echoes what other luxury goods makers have experienced, that there was this big burst of activity after the pandemic, Chinese luxury consumers snapping up lots of designer, clobber and jewellery and watches, and now that's dying down. and one wonders, how do you stabilize? Obviously, in a year's time, you again will get rid of that annual effect, so there'll be some kind of stabilization. But I think there are question marks about what that will look like. Although, it is interesting also that there's sort of a splitting off. The ultra premium, the watches above $3,000 are actually doing well. So it's not that sort of the ultra rich who don't have money to spend. It's just the question of what will be the longer term trajectory.
Okay, but is there a sense that the epic run that we've seen in the watch business is now over? Is this confirmation of that? You're seeing it elsewhere. Johann Rupert's talked about this in the past, the fact that we have run out of steam on that trade. Is this just further confirmation that narrative that came out of what happened with crypto, came out of the pandemic, has now run its course?
I think for the time being, that's fair. And that definitely seems to be why the company is also pivoting and putting less of an emphasis on watches. But it's not like it's not still, and you also saw in the UK retailer, the Swiss watch retailer, having a bit of a torrid time, the one that sells Rolexes. So I think there's definitely a sense of that. But, it's just because it was so high before, it was such a strong run, and it doesn't mean it could still have sort of moderate growth. But that is sort of what separates Richemont from the other big luxury players.
Yep. Dasha, great stuff. Thank you very much indeed, Dasha Afanasiev, joining us on what is happening with the Richemont story and the wider impact out into what is happening in the luxury trade. Watches of Switzerland actually popping higher on the 16th, traded through quite nicely this morning as well. It's up really 22% this week. I just want to double check my numbers on that, but that's what it looks like. So some strong performance maybe coming through from the watch sector, despite what we're hearing maybe out of Richemont this morning. Is there a read across into LVMH? Let's find out. Let's take a look at the core six and figure out what is happening broadly across Europe, encompassing everything. So you've seen Novo come back. ASML, we're seeing some weakness there, so luxury is certainly on the back foot this morning. LVMH, not much read across. So LVMH, fairly quiet, you could argue, given what we're hearing from Richemont this morning. Let's figure out what other stocks we need to be watching. Joe Easton, here with the details.
We're going to start a look at the watches, Guy. As you mentioned, most of the strength in that report did seem to be in jewellery and excitement around the CEO, but you also mentioned Watches of Switzerland. There we had the earnings from them out this week. That stock up 20% for the week, as you mentioned. But the fifth best performer across the entire market is Swatch, suggesting that people do like the watches numbers out of Richemont today. It's not all about jewellery, so we are seeing the watch stocks gaining. Richemont itself up 6%. That is the biggest gain since January for that one, so a big gain for the stock, but we're seeing a feed through into the timepiece stocks today, suggesting that that is also a strong part of the market. Quite an interesting dynamic with the CEO coming in, focusing on jewellery. Then we'll look at earnings. Couple out of the UK, so we go from fancy watches to diamonds. We got Petra Diamonds. This one actually declining. Not as much diamonds dug out of the ground, and profits actually declining at that company today. Then Land Securities in the UK writing down the value of their UK real estate by around £600 million, according to their statement. It's a big loss for them. Then over in France, we've got NG and also Score, both of those declining. Now, NG, this is in the utility space. A warmer winter was not good news for them, according to the statement. That might be good for some of our household bills, but not good for the company. Now, Score, this is a Lloyd's, a London insurer, a really strong part of the market, but they have seen a decline in net interest income, so that one getting hit hard on the Paris exchange. That's the worst performer on the Stock 600, or one of them, a few moments ago. So that one down over in Paris. Then we're going to bring you Aker BP. This is a very single stock story. They've got a lawsuit from an investor claiming that they've lost money on a refinancing deal. The company over in Norway is denying it. They're going to dispute it in the courts, but that is weighing on the stock, and we're down 1% on that one today. Then in terms of deals, plenty going on once again in this space. You mentioned a couple in the build-up. There's Haleon there, down 1%. GlaxoSmithKline also slipping slightly, exiting its entire stake in the maker of Sensodyne and Advil. So those two both declining today. HSBC, you mentioned Ping An potentially looking to offload shares, as reported by the Bloomberg Deals team. That one pretty much unchanged. The Rent Group I brought up, this is interesting. It's car parts, but the interesting thing with this one, it only IPO'd a few months ago, and an investor already looking to sell shares on that one, and it is coming down. It's down 2%. Surprising to see a stake sale in that one so early for that firm. Then we will look at a couple of morning calls. We mentioned H&M in the stocks to watch. Now, this one doing well, up 2.7%. RBC recommends buying that one instead of Inditex, the Zara maker. It's outperformer, 200 Swedish krona price target. It's at 180, so potentially some more upside to that one. Finally, a quick look at chemicals, because Lanxess over in Germany, this one is getting hit on a downgrade by Exane BNP. They think that this is a bad cyclical trade at the moment, and the producer has just told me in my ear that Jefferies has also downgraded. So it's a double downgrade for Lanxess. It's one of the worst performers in Germany today. It's down 4% now, actually, so Lanxess getting hit on the DAX index today.
Joe, thank you very much. Joe Easton from our equities team with all you need to know about the stocks on the move this morning. And it is very clear that luxury sort of steals the limelight, doesn't it? With the luxury sector, consumer products and services broadly, but within that, the luxury sector doing really well. Richemont up by just shy of 6.8%. Swatch, Burberry, Moncler, LVMH all going higher, not by as much at all, but certainly being lifted. It's interesting that the boss, who's stepping back a little bit, and major shareholder, saying some really interesting things about the Chinese lockdown, saying there's nothing wrong with the Chinese market. I think people were psychologically affected by the very strict lockdowns, which is an interesting take on what ails the Chinese consumer right now.
Tom's probably got a better view on this, but it does seem as if the Chinese consumer has been did not react in the same way coming out of the pandemic as other consumers have, who have come out and bought tickets to concerts. I'm not going to mention which tickets to which concerts. Tom is looking forward to his. His participation in that process. But the experience seems to be radically different to what we've seen elsewhere in the world.
So they didn't have stimulus checks.
Yep.
They didn't have furlough. And Shanghai, the beating hub, the financial centre of China, locked down for 3 months. Locked down for 3 months. Literally bars on doors. So if that doesn't impact your confidence, what does? So you're not getting that additional stimulus. You were locked down in a city where you would one of the least expected in terms of where you're going to, the most international city. And then you have the real estate crisis as well. So the turn has been dramatic in terms of the sentiment of the Chinese consumer. I can't really overplay that. Post-pandemic, from the pandemic to now, there's been a complete reversal. And you know, I speak to Chinese friends on the ground who would always just talk about the next holiday, the next car, the next thing they're investing in up until the pandemic. And that was almost universal across the upper middle class in Beijing and Shanghai. That is completely flipped on its head now.
That's incredible. And it's lasted a long time then, because, you know, this is history now. And yet this effect on consumer appetites still lingers.
I think that's a really good point as to how long this lingers. And that's clearly feeding into the urgency of policymakers meeting today to try and push through some of those changes, because they're seeing that this is dragging on. And I think, to your point, that's a question mark, isn't it? When does that turn back to a more constructive outlook for the Chinese consumer?
Yeah, and whether policy can do anything to counter that kind of sentiment is really fascinating. OK, we will be back with more on China, more on these markets, more on the luxury stocks gaining this morning. Plenty more to come. This is Bloomberg.
The U.S. economy is chugging along pretty well.
We've had good, healthy markets for quite a while.
There's 1,000 things that can go wrong tomorrow, but right now everything's in pretty good shape.
I think the chance of something going wrong is higher than people think.
Where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
Whatever the world is pricing in for a soft landing, I think it's probably half that.
Right now we have a no landing, honestly, a 2% growth rate, because you can't say it's a soft landing.
There are a lot of inflationary forces in front of us that, you know, may keep it a little bit higher than people expect.
What the Fed is doing with rate structure is having the impact they want. On the other hand, the economy's kind of there, and now we got to be careful we don't overshoot the other way.
I think, you know, they are doing the right to be patient right now.
JP Morgan, B of A, Goldman Sachs, The View from the CEOs. We've been speaking to them all this week in Paris. Interesting to get the kind of different, the kind of the nuance, the subtlety in terms of the differences in their opinion. Dimon's a little bit cautious. I have to say, Brian sounding much more positive on the economy that he sees in front of him. But that's what makes a market right now. And the market this morning, reasonably flat, not really giving us a sense of direction. Just want to point out that Norway is closed today. We were talking about Aker a little bit earlier on. That was yesterday's price, so just be aware of that. But the tricky thing right now is we're getting conflicting signals out of the global economy. We're certainly getting conflicting signals out of what is coming out of the data in the United States. Nancy Curtin is the CIO of Alti Tiedemann Global, joins us now on set. Jamie Dimon sounds cautious. Jamie Dimon's worried about inflation. Jamie Dimon's worried that markets look a little bit toppy. He says there's a lot of happy talk out there right now. Do you think he's right? Do you think Jamie's got a different time perspective on some of these things?
Look, Jamie Dimon runs one of the biggest banks in the world, and he's got to think about the upside and the downside and the lending market as well. But we have to run portfolios on behalf of our clients. And we moved overweight in equities last year, believing that the markets were too cautious and that we would achieve a soft landing. That is still our view. And actually, even though the Fed has not cut interest rates, liquidity is pretty good at the moment. Yep. Look at the corporate credit. Look at the equity market. I think it's been a pretty positive beginning to the year.
How worried are you about the tail risk, though? Because the markets increasingly feel like they're don't see those tail risks as being germane anymore. The risk that actually inflation stays sticky and the Fed and other central banks maybe can't do as much in terms of cutting rates as maybe we had anticipated. We're pricing 2 now. Does that go to 0? And what about the risk on the other side, which is that actually you've got some warning signals out there flashing a little bit, maybe not red, but certainly amber. Walmart yesterday talking about the fact that even kind of high middle income shoppers are trading down. You got Deere yesterday talking about the fact that they're not seeing the demand that they once had as agricultural prices come down a little bit as well, affecting the industrials. There's some warning signals on both ends.
Sure, but you got to navigate through that. And let's begin with inflation, first of all. I think that was a collective sigh of relief. What happened on Wednesday, in other words, we saw signs of a little bit of disinflation. But it's been our view that the Fed could remain cautious here, may not cut rates at all this year. But so far, economic growth and earnings growth, we think, will trump what's going on in terms of the Fed policy. Remember, liquidity is pretty generous. Look at corporate issuance. Look at corporate spreads. We've reduced QT. We've got bond yields coming down. These are all kind of positive signals as well. You talked about the consumer in the sense of there is some slowdown, some evidence in some of the retail side. But think about services. In the first quarter, consumer spending on services rose over 4%. Yep. That's like the highest in 2 decades. So what are we doing? We're switching from goods, maybe, to services. I do think some of the lower-end consumers in the United States also experiencing maybe a bit of a pullback. Inflation does impact them. Maybe a bit of a K-style economy, but it looks to us like growth is still pretty solid in the States.
A K-style economy. And to be absolutely clear, you see a Fed that could stay on hold this year, but nonetheless, the stock story continues to be constructive because all of those factors you pointed to. What about the liquidity impulse, then? The cash that's on the sidelines? And what is the next catalyst in the short term? Is it Nvidia next week?
Well, I think Nvidia is going to be important next week as we're going to get more information on that Blackwell, which is about 21 times the performance of the A100. So, and look, this week we continue to see lots of interesting news on Gen AI, right? Project Astra. Have you tried ChatGPT 4.0, right? So some of the power of these applications is still to come, and I think that will encourage investors. On Nvidia, TSMC's earnings were pretty good. I think that's a nice bellwether.
So that AI catalyst continues to run for the markets?
I think it does, because I think people are continuing to see the advancements. We haven't stood still in Gen AI. We have multimodal, text, video, programming, language translation, tutors. Let me find my glasses somewhere in the room. I think lots of things are happening there, so people can extrapolate about the productivity improvements ahead, and that helps, right?
Yeah. Sorry, you're saying AI is going to help me find my glasses?
This will help
because I lose them all the time.
I know.
Suddenly, Guy Johnson's all in on this AI revolution.
You have to see Project Astra. Did you see it? I mean, he holds
the
it up.
The video is very cool, isn't it?
It's very cool. We're in my eyeglasses over there by your computer. Hello.
Will they help him find which pair to put on?
That's also a critical factor as well. But if you improve my eyeside, that would be the main thing.
That'll be excellent. That'll be really good. I mean, so you don't worry then, Nancy, when so you're clearly excited about AI, and we watch that manifesting itself largely within the tech space, but then you wonder where it delivers for other industries, other sectors with a longer time horizon. Do you get at all concerned about, 2000 and what happened when we all got excited about every business but .com after their name? No. And then we all, the potential for the internet was not wrong, but share prices ran away with themselves. You don't get worried about that.
Yeah, I mean, 2000. Well, you had Pets.com, not exactly a durable business model, trading at like stratospheric PE multiple, no earnings, no cash flow. These companies are sitting on huge cash piles. They'll probably deliver about 25% earnings this year. But it's not just about tech. I want to be clear. One of our things that we've been talking about is this broadening in market participation. 10 of 11 sectors delivered very nice earnings in the first quarter. And actually, you can see not just the tech sector, but industrials, financials. How about utilities? You notice what's going on, utilities? There's like a power thing going on because we need more power. These utilities are growing for the first time, the top line, and we think there is a super cycle happening in power.
And so how reliant is this outlook of yours, Nancy, on rates coming lower? You mentioned rates dropping, but you don't think the Fed's going to cut many times this year, and you think that doesn't damage stocks too much. But what kind of effect will we see on stocks if we don't get rate cuts and if rates stay high or even go higher?
Remember, what we're going to be focused on is earnings, and earnings are anticipated to accelerate as we move through the year and also broaden to more parts of the economy. That is what we're looking for. If we don't see that, then obviously that's some of the risks that you mentioned. But it's really about earnings. But remember, you go back to liquidity. Corporate credit's on fire. Spreads are the narrowest they've been in over 2 decades. The Fed just did QT, lessened the amount of tightening. Bond yields have come down.
Can they get any tighter? Can they get any tighter? Because they feel really tight right now, as you say. Isn't the risk actually the symmetrical risk on spreads that actually we see them widening out a little bit?
Well, I think, look, at the end of the day, there's been a huge amount of corporate issuance that continues to drive spreads lower. I think companies want to issue before the election, right? There's some
So you think they can go tighter?
I don't know if they'll get tighter, but what I would say is it's not exactly hard to access liquidity, is it, right? So even though the Fed hasn't cut interest rates, I would say liquidity conditions are pretty benign for corporates, and that's supportive of earnings as well. So earnings is what we're going to be watching, clearly, to see that acceleration in earnings as the year progresses. If that doesn't happen, then that's a different story. We'd become more cautious. But, we don't just own equities, and I want to make that clear, in the fixed income, or what I call non-fixed income space. There's lots of things. Gold is up 15% this year.
Yep.
Private credit is tracking to about 8 to 10%. Infrastructure, really interesting.
And with
right?
infrastructure in mind, how does the politics play in? Do you position for change, Nancy, later on this year and into the next 4?
I think you can't guess what's going to happen in the election in the United States, other than perhaps to expect more tariffs. But let's face it, what Biden put so forward is 4% of the Chinese export. So it's not really a big deal in terms of its impact on inflation or the U.S. economy. So we can't really project what's going to happen in the election. But what I would say, it doesn't look to me like either president wants to cut back on fiscal spending, right? So that's not bad for growth.
Nancy, thank you very much. Thanks for joining us. Nancy Curtin, CIO of Alti Tiedemann Global. We thank you for her time. Coming up, we'll talk about commodities. Copper has been surging as demand is seen to only be growing. This all about the energy transition. We'll be back to that subject. This is Bloomberg.
I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have 3 sources of demand this time around, meaning green capex, AI, plus military. Back in 2021, all we had was the green capex demand, and now it's in full force. Supply's not there, inventories are tight.
Jeff Curry there, Chief Strategy Officer of Energy Pathways on copper demand. For more on the copper story and the wider commodities landscape, let's bring in Marcus Garvey now, Head of Commodities Strategy at Macquarie. Group. Marcus, thanks for joining us this Friday morning. Appreciate it. On copper then. So Jeff Curry coming out with a view that you could get to 15,000. That's his kind of target level in terms of pricing for copper. You called this cyclical upswing for commodities back in a note back in March. Where are we in that upside? Does 15,000 sound reasonable to you?
I think not in the short term, to be blunt, but maybe on a 2 to 3 year view, you can run scenarios where very high numbers become plausible. But I think one of the things that's really striking to us about the upswing that you're currently experiencing is that prices are actually beating our expectations from that note that we put out in March, and even looking a little bit back to February when we started to get more constructive on the sector. But in the near term, fundamentals are lagging. And you could argue that markets are pre-pricing tightness that's still to come. But there is evidently a risk at this stage that a lot is already in the price. And if fundamentals don't catch up quite quickly, you are vulnerable to a correction. So at this stage, I would really stress that actually it's the financial markets that are really driving the price action in the near term, and that physical is lagging what we're seeing. So that if you look at physical premiums, if you look at inventory developments, maybe with the exception of the US copper market, or if you look at, say, import arbitrages into China or Chinese apparent demand, biggest single center of demand for all of the major metals markets, none of them are actually particularly strong at this point. It's the financial market more than the physical market that's making the running here.
OK, so, I mean, Marcus, you're painting a picture of it. This is a kind of speculative play at this point by the financial markets. Talk to us about the demand-supply dynamics then and the fundamentals. What is most consequential in putting a kind of fundamental floor under the price? Is it China at this point?
I think you've got to separate a little bit out there between the very short-term and the medium-term point, in the sense that the argument that's being advanced, which we agree with, that copper has a very strong medium-term outlook. You can debate quite how strong, what that means for pricing, but I think almost everyone would agree it's very constructive, comes back to a fundamental view. But that what we're looking at right now is a market which is, to some degree, pricing that fundamental development that's expected to come, but it's not here yet. And so that, to my point, it gives you an issue where the longer you don't see the fundamentals really start to deliver, you're vulnerable to a catch down if, for example, any negative surprises either on a fundamental or on a macro basis. Because if you look at most people's forecasts this year for the copper market are for a deficit, some very, very large deficits, even as high as sort of 700,000 tonnes. Our own deficit estimate is about 250,000 tonnes. But that year to date, copper inventory is up almost 400,000 tonnes. You should build seasonally in the first quarter of the year, but you should draw consistently in the second quarter of the year, and that's not happening yet. And so the ability of the physical market to get to where the financial market's expecting is starting to look a little bit challenged, that the financial market might be doing too much too soon. And there's a lot of speculative length in the market at this point.
Yes, and does that apply to New York in particular? We saw this phenomenon where the spread between the New York price and the London price seems to get stretched versus history, Marcus. It sounds from what you're saying that shouldn't be the case.
I think there's two aspects to that. One, exactly that shouldn't be the case on any sort of sustainable basis. There's no reason that over time you should see the premium in New York be anything outside of a normal sort of physical arbitrage level. We saw it briefly intraday go to about $1,000 earlier this week. The underlying cause of that is that a large portion of that financial length is sitting on the CME market in New York, both, I would argue, macro discretionary and sort of generalist capital, and also systematic momentum funds that have been investing in copper. But that in addition to that, and this is key for enabling that move to have happened, is that the US market is actually regionally tight right now, even in the context of a global market that's not that tight. You look at Europe, you look at Asia, ex-China, you look at China domestic, those markets aren't currently that physically tight. The US is. But the degree to which that's unsustainable is because you clearly opened up a physical arbitrage. It just takes a bit of time to close it. So that why I say that's unsustainable is because if you look at sort of August, September, you could easily find enough copper physically moving into the US to close that arbitrage. And I think you've already seen people starting to position for that in the physical market.
Yes.
Whether you actually even see that arbitrage still be open come that time is probably a function of what happens on the financial market side. If you see a bit of a positioning pullback in New York, then you reduce the degree to which that arbitrage is likely to be open. So it may unwind financially rather than physically.
So important to keep in mind the regional dynamics then as you describe them. What kind of a bullish signal, Marcus, do you think the BHP bid for Anglo was around copper? Because here you had a business that was that received a takeover offer and was prepared to strip out almost all the other parts of its business to allow the market to value it as a copper play. How bullish a signal should we read that as?
I think from a short-term market perspective, it doesn't really tell you that much about current market conditions quite clearly. But on a medium-term basis, what it evidently underlines is that in BHP's view, and of course they may be wrong on this, but they should be in a position to have a fairly reasoned opinion on it, the current market valuation of copper assets, in their view, is too low. And so if you're just thinking about that from a copper on a sort of build versus buy assets basis, if you think those assets are too cheap, implicitly, it's a very bullish signal for the copper price. I would add one caution, though. If we look at corporate M&A in this space over time, it doesn't have a particularly consistent track record in accurately forecasting the copper price. So whether or not they're right is possibly a broader debate.
Marcus, if I park the M&A story to one side, though, is there better value if I want to make the copper play in the metal or in the stock? Where am I going to get the biggest kind of return if I want to make this story work?
Well, I'm restricted in what I can say about equities, unfortunately, in terms of where I sit within the business at Macquarie. But I think as a general point, I would say what you've got to disentangle somewhat is the fact that the stocks can trade on a sort of future discounting basis, but that ultimately the physical market has to trade on a spot basis, and that can have future expectations baked into it, but that when you're in the current market conditions where a lot is baked into it and the spot market itself is not there, you do have a big vulnerability in a physical commodity market, as we've seen in numerous instances over time, where a lot of speculative length comes in, often with good reason, but you do too much too quickly. You do find that the physical market is then quite susceptible to a pullback in that commodity price itself.
So it depends on your investment horizons. Just a quick question on nickel. Nickel up this morning. Looks like we do have a problem in New Caledonia. The French are trying to gain control of that. Nickel, obviously, a battery metal, amongst other things. It's used in armaments. It's used in various other things. The nickel price has risen pretty sharply at the moment. Is that something that, again, is a short-term story that we're seeing, obviously, a near-term dislocation in the market having an impact? Or is that something more sustainable? And is that something that I should read into the wider battery metal story as well?
I mean, for nickel, a big consideration really is that, irrespective of what happens in New Caledonia, what's going to really dominate the supply side of that market is what happens in Indonesia. And a key part of the recovery you've seen in the price off its lows year to date is the fact that in the first quarter of this year, in particular, Indonesian exports were quite weak. You had a lot of disruptions around mining permit issuance following the change of, or leading up to and following the change of president. If you now see, particularly as prices have bounced back to levels where previously we were well into the cost curve, we've moved out of that now, you're at a level where you're incentivizing to supply pick back up. And if you're not finding disruptions to that in terms of things like regulatory issues, actually, can the nickel market really get tight in the second half of this year? I think that's probably quite challenged unless you do find that Indonesian supply is persistently disrupted.
Marcus, I want to get your views on gold, up 20% or so in the last 12 months. How do you see the price action around gold evolving in the months ahead, and how much of this is a central bank buying story?
It's definitely been a central bank buying story for really the last sort of 2 to 3 years. But actually, if we look at the other major drivers, I think the two biggest drivers that have really pushed the gold price to where it is now is that we've seen Western investors, while they've still been somewhat sensitive to increased interest rates, they've actually been less sensitive to that than historic relationships would suggest. So they've really held on through this period of a rate hiking cycle and underpinned a lot of that gold price performance. And then the additional kicker that's really come in very strongly this year has been Chinese investors rather than Western investors adding a bid and pushing gold price up to these sort of all-time nominal highs above 2,400. I think in the short term it feels reasonably neutral to us. You could make a sort of $100 case either way in the next couple of months or so. But when we look towards the election, I think in the autumn, that could actually be a really key point for gold's price performance this year. Because if we think about why Chinese investors have been so active, I think a few things which may be changing. We're seeing some policy announcements today on the housing market that have been, weak housing market, weak equity market has encouraged some investment into gold. Those things may move around in a positive direction in the next few months. But a big feature has been concern about RMB depreciation. And if, as we head into the election, the market is pricing a reasonable possibility that President Trump wins again, and that also he is still talking about putting 60% tariffs on all Chinese imports into the US, then there will be an implicit risk that you do get a period of RMB weakness after the election. And I would think that the way that is hedged by onshore investors with capital that's onshore is that you buy gold. So I think there's a very good chance that as you head into the autumn, you get a very strong Chinese investor bid coming back, as we experienced particularly in April, actually, this year, and that could be a catalyst to push gold up another leg higher.
OK, that's really, really interesting. Marcus Garvey, head of commodities strategy at Macquarie Group, tying the elections in the US to the gold price and the consumer, at least the demand out of China. Really fascinating in terms of some of the key drivers there, but also cautionary in terms of the pricing we're seeing on copper, given the lack of fundamentals, arguably, to support the pricing, at least at current levels. Now, from earth metals, digging in the ground, to outer space, resources in space. Let's turn to the satellite story then. Elon Musk's Starlink is transforming communications across the globe. Bloomberg Originals has been looking at how the company's dominance is sparking government scrutiny and encouraging deep-pocketed rivals.
The largest single constellation of satellites orbiting our planet is run by a mercurial individual who needs no introduction. It's this guy. It achieves this by maintaining a vast relay network in low Earth orbit. That's the area higher than a jetliner, but below a GPS satellite.
Right now, Starlink has more than 5,600 satellites in orbit.
And it accomplished all this in less time than it took James Cameron to make a second Avatar movie.
At one point, SpaceX envisioned launching up to 42,000 satellites.
But this speed and relative success has raised eyebrows, concerned ones in government, and excited ones in the boardrooms of potential rivals.
It's essentially a company trying to disrupt a somewhat complacent marketplace.
That is just a glimpse of the full programme. You can catch the full Bloomberg Originals episode on Bloomberg.com and on YouTube. Plenty more Bloomberg Originals videos, reports on there, so you can enjoy those over the weekend. Coming up, plenty of sport over the weekend, I'm told. F1 world champion Max Verstappen speaks to Bloomberg about growing the sport and the recent personnel changes at Red Bull Racing. We'll bring you our interview next. This is Bloomberg.
My view is that whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
What does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Happy talk. JP Morgan CEO Jamie Dimon speaking to Bloomberg's Francine Lacroix at the bank's Global Markets Conference in Paris. Pretty critical of the happy talk that he says is supporting markets. Not too much evidence of the happy talk this morning here for European stocks. We're down a little bit, down 0.2% on the Stoxx 600 this morning. Just looking for US futures. Well, they're flat. They look, I don't know, content rather than happy.
Well, it's been
content with the gains.
Well, maybe you just hang on to your gains. Maybe you just sort of sit back and enjoy the gains. Maybe that's what makes you happy after what has been a fairly decent week for for equity markets.
Do you want to talk about the Dow Jones?
Let's not talk about the Dow Jones. I'd be interested to see kind of the M Live take is that maybe you can, or maybe not the entire M Live, maybe certain portions of the M Live believe that maybe you can listen to Dimon but appreciate that he has a different time reference. Yeah, and central bank officials as well seeming to try to kind of curb our enthusiasm to some extent. In terms of FOMC officials overnight saying, look, we're still higher for longer, even though inflation came in better than expected. And then ECB officials as well, yes, from the hawkish spectrum, suggesting that, OK, we get a June cut, but don't hold on to your horses.
Still don't get the sense markets are listening, though, do we? I mean, even if we've paused here,
the market that's listening right now?
We've still seen gains, haven't we? And they're not selling off on the back of it.
So to that point, who said it this week? I can't remember who said this week that at some point the FOMC is going to have to take the view that it needs to kind of change market perception. Because the markets, basically, if you look at the financial conditions story, have just loosened financial conditions significantly.
But when has Jay Powell been worried about that, though?
So he hasn't, but at some point does he have to be? Because the US... How do you slow the US economy down? If you do get a pick-up in inflation, what is going to drive that narrative? And I think that's the concern. Is it going to be actually the K-shaped recovery, the fact that there's actually quite a lot of money still sloshing around the system, lots of liquidity?
There's been lots of fiscal spending, and there's also been lots of spending on experiences, such as concert tickets.
Don't look at me, look at him. Don't look at him.
I'm coming to you with this nice segue. Concert tickets and going to watch F1.
OK. Nice try.
It says Guy on the prompt.
It does. I'm just saying that he's going to Taylor Swift, not me.
Oh, I see. Oh, I didn't know that.
But he's been buying the merchandise.
You didn't know you were going to...
No, I didn't know that.
I don't know if I know... Yeah, going to Taylor Swift.
Oh, August. Okay.
Yeah.
To deal with some of the other traumas.
I'm still debating who the plus one is going to be. The merch, though, is being bought by Guy Johnson. Apparently, in terms of the Taylor Swift, he's got the hot pants, he's got the T-shirt, hot pants. Guy Johnson in Taylor Swift hot pants. There you go, Guy. Over to you.
What? Why? OK, we should now move on. Basically, Imola this weekend, one of the great sporting things that we're going to be watching. You've also got quite a lot of boxing. You've got some football to talk about. I'm just kind of getting Anna warmed up here to talk about all of these things.
Don't worry,
in just a moment. It's obviously a huge moment for the sport as we continue to see Verstappen doing incredibly well. The sport has been doing well, not only on the racetrack, but also, obviously, in terms of its commercial success over the last few years. We've all seen, well, I've seen it, maybe not Anna, Drive to Survive has been a big feature, certainly in my house, and there's been multiple spin-offs of that as well. So that's had fans flocking to the sport. How do you continue that strategy? Well, the current world champion, Red Bull's Max Verstappen, spoke to Bloomberg's Jason Kelly about how F1 needs to consider different ways in terms of how it continues to grow from here and keep fans engaged.
It depends how you want to attract fans. Like, you can attract it, of course, in very different ways, right? You know, from the entertainment side or actually the performance side of things. And of course, you know, the sport has been growing a lot lately, probably from, you know, more the entertainment side. But, you know, you also need to question, like, what you actually want, because I think it's also very important to keep, you know, the real die-hard fans, you know, really engaged. But, you know, these kind of things, at the end of the day, like, you know, I'm the racing driver. I'm very focused on my performance. And, you know, that's already taking a lot of my time, you know, trying to just be on top of my game, you know, being, you know, in touch with my team, what we can try and improve. And, you know, to be honest, those kind of things are not really going through my mind a lot, you know, how should I grow the sport? I mean, that's not up to me. I'm not, you know, also the shareholder of the sport. You know, I'm just here to try and win the races.
That's a fair point. And obviously the commercial success does, as you rightly point out, rely very much on success on the track. No one would question your success on the track. It's worth pointing out that obviously, you know, there's going to be a big change with Adrian Newey leaving. What's your confidence level, I should say, about that side of the equation moving forward, ensuring that you can stay competitive on the track?
Yeah, I mean, it's of course, you know, it's been you know, quite a change, I guess, but also a shame that, you know, Adrian will be leaving, because I think it would be always nice for him, you know, to be part of what we are doing. I mean, he's been incredibly important for us, especially from the start of Red Bull Racing, I would say. And yeah, I mean, at one point, you know, you have a lot of good people in the team, a really strong technical department that I trust in as well, you know, for the future. So naturally, the confidence is very high and very excited for the coming years as well. But yeah, would it have been nice for Adrian to be around as well and see that? For sure. But at the end of the day, you know, when people want to maybe seek new challenges or whatever, you can't stop that.
Max Verstappen speaking to Bloomberg's Jason Kelly, talking about kind of how the sport develops from here. His focus very much on the racetrack. Imola this weekend, one of the key events. One of the key. It's not the. There's two in Italy. There's two races, so this isn't necessarily this isn't the Italian Grand Prix.
Got it.
But it's Imola, so it's a nice part of the world. What else we got? There's a big fight this weekend.
Yeah, hang on, before we get that, the Formula One thing. So he says he wants to attract. They want more viewers. Obviously they do. Yeah. But like, it's just boring because he keeps winning. Isn't that the problem?
There is that.
He's part of the problem. He's too good. They've got too much dominance, Red Bull. I mean, that would be the argument from some. It's not my personal view.
Well, I mean, people argue that Netflix has made it more about the entertainment, you know, and maybe that was a feature of. Sure, he's winning at the moment, but that was an old criticism of Formula One, wasn't it? And then Netflix
the criticism of many sports is they don't embrace the entertainment side. That if you want sport to be successful, you don't want to be pitching it to the diehard fans. You want to be bringing in new fans. You want to be making it entertaining. And that's what the Drive to Survive story...
And they've managed to bring in a lot of female viewers as well,
has done, yeah.
Apparently so.
Anna's not one of them.
not Anna. Still the holder.
No, I'm taking back Max Verstappen's line here. He said, when asked about growing the sport, he says, I don't know. I concentrate on racing.
That's not my job.
I don't talk about sport. I concentrate on other areas of news.
Yes, like cement. So...
you missed it earlier on this week.
I have very serious interests.
In concrete.
Right, and whilst you're all watching the sport, I'll be, I don't know, playing the piano or something.
Boxing.
Enjoying myself.
There's boxing. OK, yeah. Excellent. The piano's going to be fantastic. I'm sure it's going to be very enjoyable.
We need a rendition.
But yeah, we do. Yeah.
No, that's not happening. That's not happening.
Boxing, we've got. Yeah. Arsenal fans, I think, have probably got everything, fingers crossed, toes crossed, everything like that.
Absolutely. Sunday's a massive day.
Sunday's a really big day. Final weekend.
Both kicking off at the same time. 4 p.m. Sunday.
So which kind of...
Man City and Arsenal.
What happens with West Ham? That's going to be interesting as well. The Everton... anyway, it comes down to... Man City look like they're going to probably win it, but if I was an Arsenal fan, and I remember living in Highbury when they won it a couple of times, and Upper Street was bedlam. It was fantastic. So that would be absolutely amazing. The golf, Schauffele, 62. This is the exact opposite of the Masters. The Masters was so windy that everybody was really struggling. There was no wind yesterday. Some massive scores coming down as a result of that. Loads of birdies.
Under 9, -9.
Yeah, this
Whatever
is
that
huge.
means, that's a good score. I know that's a good score.
You know what that means.
$20 million prize money.
Yeah.
That's the total purse. Valhalla. $20 million.
It's second major, so we'll watch that this weekend as well. So Anna's going to play the piano. There's sport to be played.
Tom, I'm very glad you're here, because the director sat on a wide shot throughout that entire conversation, just to emphasise how little I had to say on the subject. But excellent. I'm glad have we done justice to the...
We have. What else is coming up for the rest of the day, Anna?
OK, plenty more coming up. In fact, in the next hour, let's just deal with that, including an exclusive interview with Pascal Donohoe, the president of the Eurogroup. Joint debt issuance could be part of that conversation. Also joining Francine Lacroix on the pulse, the president of Georgia, in fact, to take a much more serious turn when it comes to the country's ruling party facing protests over its foreign agent law. That has been making a lot of headlines globally. So we'll certainly bring you that important conversation. That is it for markets today. Markets themselves actually down 0.25% as we bring the trading week almost to a close. Still early here in Europe, heading towards the US Open, flat to negative. This is Bloomberg.